There's the audience. Here's the setting. Have you ever dreamed about having your own business? Most likely yes, since there's more than 30 million small businesses only in the US. Now the bad news is that almost 50% of those small businesses fail during their first year of life, and about 90% fail during their first 2 years of life. So if you don't want to fail and you want to have your own business, today I'm going to talk about something extremely important: working capital days and how to manage them. Working capital days is composed of three main metrics. The first one is the days sales outstanding, or DSO. The DSO is a measure of how many days of sales we've got in our accounts receivable. Since typically we don't sell everything in cash, and sometimes we need to extend credit or use credit cards, this is why we measure our DSO. So the lower the DSO is, the better, since we want to have more cash and less accounts receivable. Let's see how we calculate this measurement called the DSO. In this example, we can see that the components of the DSO are the accounts receivable, which we divided by the total sales of the month, multiply it by the number of days in the month, and that is how we calculate our DSO. So let's look at a very brief example. If our accounts receivable are $100, our sales of the month are $100, and we've got 30 days in the month, then our DSO is going to be 30 days. The second component, and also very important, is the days inventory outstanding. Here we're talking about how many days of inventory we've got. The DIO is a measure of the number of days of products that remain unsold. What we want to do is to sell the products as quick as we can, not to have them in our shelves. So the lower the DIO is, the better it is for the company. Let's look at how the DIO is calculated. For the calculation of the DIO, we consider the inventory that we've got on hand, and also the cost of the product sold, or the cost of goods sold, of the previous period that we're measuring. So our DIO is going to be measured as the total inventory divided by the cost of goods sold, multiplied again by the number of days. So again, let's follow a very simple example. If our inventory was $100, our cost of goods sold was $95, we know that we have 30 days in our month, then our DIO is going to be 31.6 days. Remember, we want this number to be the lower the possible. And the third component of the working capital days is the days purchasing outstanding. In this case, what we're measuring is basically our accounts payable. The DPO is a measure of the number of days that we need to pay to the vendors. So the higher it is, the better. If the vendors extend us credit, we want to pay them as long as we can, so that we don't use our cash. Let's look at another brief example. The DPO, as we said, was a measurement of our accounts payable and our total purchases. So how do we calculate it? We divide our accounts payable by the total purchases of the month, and once again we multiply it by 30 days. In a brief example, if we have at the end of the month an accounts payable of 120, meaning we owe our vendors and suppliers $120, we purchase $100 during the month, 30 days, which is the number of days, our DPO is going to be 36 days. So with these three components, we calculate our working capital days, which is going to be our DSO plus our DIO minus our DPO. That's why we said we want this number, or the DSO, to be the lowest possible, we want the DIO to be the lowest possible, and we want the DPO to be the highest possible. So in our example, our working capital days would be 25.6. Now why is this so important? This means that for our total sales, we need to have a total of 25 days of cash if we want to operate. If we want to sell $1 million reduce that number? Of course we can. If we keep on low inventories, if we give little credit, and we gain a lot of credit from our vendors, then this number could be a lot less than 25. Ideally, it could be even 0, which means that we don't need money to operate. This is why working capital is so important. If we get out of control, then we run out of cash and we basically end out of business. So hopefully you've learned something new, and when you start your own business, keep in mind, always worry about